After the Great Recession, the banking system recovered and inflation remained low. For quite a while, it stayed this way, and it never went above 2%. However, the times have changed, and in recent months, inflation began to seep its way into the economy. US President Joe Biden has called the situation transitory, but a lot of people worry that inflation is here to stay. Assuming that it might actually happen, how do you keep earning while keeping your money safe? We'll talk about that in today's video. Hey, welcome to Stock Market Mate. Today we'll talk about how to make money out of intense inflation. Before we get into it, subscribe to this channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Basically, inflation is the general rise in prices in an economy over a specific period of time. The Federal Reserve normally aims for a moderate and stable rate of inflation of roughly 2%, which can reflect a strong economy. However, economic stocks can cause inflation to rise into double digits. Over the course of history, inflation was never consistent. It went up and down, but it always remained in one form or another. During the 1970s and 1980s, prices increased from 10% to 15% in some years. Since then, inflation has eased significantly. In the 2000s, inflation rates ranged between 2% and 5%. In the 2010s, inflation hovered between 0% and 2%. In other words, prices have been remarkably stable in the recent past compared to the other times in history. Recently, however, inflation has made its way back into our lives. For the 12 months that ended in July 2021, inflation clocked in at 5.4%, one of the highest rates in many years. Many famous investors believe that it's coming real soon. With that in mind, you must know how to prepare for it. What then are the signs of an upcoming inflation? Utility stock prices. Everyone knows that utilities have a relatively stable share price, and they also have above-average dividends. Because of this, they have long been considered bond proxies. This is basically a stock that behaves like a bond. When interest rates increase, utility dividends look less interesting to investors than newly issued bonds. A sustained sell-off in utility stocks may signify a Wall Street consensus that inflation and interest rates are going to rise. This is because stock prices look forward rather than backward. A sustained rise in the yield on the bellwether 10-year Treasury note can mean the same thing. Commodity prices. Another yearly warning sign of upcoming inflation is the increased price of raw material prices, such as copper and lumber. These are economically sensitive materials. You need copper and lumber when there's plenty of new housing construction. There's a reason why they call copper the metal with a PhD in inflation. This is because the sharp increase in base commodities means that demand for raw materials outstrips supply. However, costs for raw materials don't appear to be rising at this time. Copper prices are more than a third lower than their peak in November 2010. Compared to the most recent peak in 2013, lumber rates are currently around 20% or lower. Base commodity costs aren't reflecting any inflation, if there is any. Precious metals. Silver and gold are frequently promoted as inflation hedges. After all, people turn to physical assets like gold as a means of exchange when they lose faith in the value of paper money. According to gold dealer Kitco, the price of gold peaked in September 2011 at $1,895 per ounce. It is currently being sold for around $1,173. Typically, when the dollar weakens in global currency markets, gold increases, but you should at least be aware of early inflation warning signs if gold prices continue to rise. Factory capacity utilization. When inflation takes a toll on the economy, companies are bound to no longer keep up with the demands. One way to inspect how a certain business keeps up with the demand is to look at factory capacity utilization. This is a figure produced by the Federal Reserve on the 15th of each month. American factories have been running at 80.1% capacity since 1974. However, it plummeted to 66% during the 2009 financial crisis. The latest figure was 79% in April. When manufacturers are functioning at approximately 84% in capacity, economists often start to worry about inflationary pressures. However, it doesn't seem to be a problem at the moment. Wages. Inflation is loosely described as having too much money but not having enough goods and services. In other words, one criterion for inflation is a big growth in the money supply. And since the bankruptcy of Lehman Brothers in the year 2000, the Fed has been pouring unprecedented quantities of money into the system. They do this through its normal open market operations, and it's through extraordinary bond buying programs, called quantitative easing. The results only yielded a small rate of inflation. The Fed doesn't hand out $1,000 checks to every person in the community when it puts money into the system. It purchases government securities in the open market with freshly printed money, which raises the money supply. The true power of the Fed's monetary policy is that it cuts interest rates, making it cheaper for individuals and companies to borrow. The concept of a wage price spiral is used by economists, and it describes how prices rise as demand rises. Employees want more compensation when prices rise. Additionally, they receive high earnings if the job market is tight enough. Prices then rise as a result of that. To date, unemployment has been high enough to prevent a wage price spiral, even though the official unemployment rate is 5.5%. Now that you have a heads up on an upcoming inflation, let's get to the good part. How do you make the most out of inflation? Contrary to popular belief, this phenomenon can actually bring you wealth. Here's how to make money out of inflation. Number 5. Real estate. Single-family homes paired with cheap, fixed-rate mortgages tend to perform well during periods of inflation. As inflation increases, your property is likely to rise in value while the monthly service cost of your mortgage stays stagnant. Building home equity is fundamental to boost your net worth, which can happen very quickly. You can protect yourself from rising rents by investing in real estate. Rents typically increase when inflation soars, as with any consumable commodity. Even though mortgages are less versatile than rental contracts, they offer a benefit when inflation is high. Number 4. Value stocks. Some studies suggest that value stocks perform better than growth stocks during inflation periods. Value stocks are companies with high earnings with respect to their present share price. They're also known to have powerful cash flows, which investors often favor when prices are rising. Some research has suggested that value stocks tend to do better than growth stocks during periods of inflation. On the other hand, growth stocks tend to be more sensitive to changes in interest rates. This is its common monetary policy reaction to inflation. Over the past decade, when inflation has been notably absent, growth stocks enjoyed a golden era. But lately, value stocks have created a comeback. Their success is likely to continue given the existing circumstances. Number 3. Commodities. In addition to raw materials and diverse natural resources that are necessary for production, commodities also include gold and other precious metals. Quite simply, as demand increases, prices rise in the economy, and the cost of production to meet that demand typically rises too. This is why in those uncertain times, commodities are frequently viewed as safe haven investments. Although these commodities don't pay dividends, they're mutually independent of the traditional asset classes of stocks and bonds. Number 2. TIPS. The Treasury Inflation-Protected Securities, or TIPS, are marketable U.S. Treasury securities aimed at combating purchasing power erosion. TIPS have periodic inflation adjustments, and these can't be found in traditional fixed-rate bonds. If you're the type of investor that's interested in capital preservation and stable purchasing power, then you should consider TIPS as a component of your portfolio's lower-risk section. TIPS holders can have certainty that they'll get their principal back, provided that TIPS are guaranteed by the full faith and the credit of the U.S. government. Number 1. I-bonds. Inflationary periods trigger interesting investments in the United States. Even though you can only purchase $10,000 annually and they're considered non-marketable securities, I-bonds are sure to keep pace with inflation. Like TIPS, they offer a nearly guaranteed return of principal. You won't get outsized returns by investing in I-bonds, but you will protect your purchasing power for a segment of your portfolio, given that many investments are likely to lose real value during inflationary periods. Like cash and long-duration bonds, it makes sense to think of other options beyond stocks that stand a chance of keeping pace. In the end, inflation isn't all bad. It's actually an opportunity for those who think outside the box. Of course, before you venture into new investments during a period of inflation, remember to diversify your assets. Well, that's about it for today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!